Hello guys. This is Lucas from the Early Retirement Club again. And in this video, we are going to show you one critical method that we use to compare and select winning stocks. As investors, we are always faced with the problem of evaluating different stocks. We are always trying to decide which stock is better. And more often than not, comparing different stocks is like comparing apples to oranges. Well, today, we will compare two very different stocks. The Apple stock against the Lockheed stock as an example to showcase the difficulties of comparing different stocks. And also to showcase how we use a method used by Mr. Warren Buffett to solve this problem. So let's get right into it. In case there are viewers who are not familiar with these stocks yet, let me first provide a quick introduction of both stocks. Apple stock, ticker number is AAPL. It designs, manufactures, and markets smartphones, personal computers, tablets, and accessories worldwide. It is the most valuable publicly traded business in the world. Lockheed Martin. Ticker number is LMT. Lockheed Martin is a global leader in defense systems, with concentration in space and missile systems, electronics, and aeronautics. Its iconic F-35 fighter jets are the most advanced in the world. So here we are, two very different businesses. iPhone versus F-35 jet fighters. How do we evaluate which is a better business? When we buy the stocks of a business, what we are buying really is its profitability. So as a result, the most important aspect to evaluate a stock is its profitability. I am sure that you know a range of metrics already, like gross profit margin, net profit margin, and so on. But these metrics are of limited use. It is hard to compare them across different business sectors or industries. As an example, the net profit margin of Apple has been about 21% in recent years. And the net profit margin of Lockheed Martin has been about 11% in recent years. So if we compare Apple versus Lockheed Martin by the net profit margin, Apple is the winner. However, if we look at return on equity, ROE, the ROE of Apple has been about 85% in recent years. And the ROE of Lockheed Martin has been about 192% in recent years. So if we compare Apple versus Lockheed Martin by the return on equity, Lockheed Martin is the winner. So what do we do now? For viewers new to these concepts, here we provide a tutorial to illustrate them. First, let's see how we analyze the ROE of a business using the Apple stock as an example. We first go to the income statement to find the net income. Then we go to the balance sheet to find the total share equity. And finally we divide the net income by the share equity to get the ROE. As seen, the ROE of Apple in the recent years has been in the range of 56% to 135%. With an average of 85%. Quite impressive. To put things into perspective, the ROE of the overall economy is only about 17%. So Apple earns 5 times more profit for every dollar of equity on its book than the average. Quite impressive. Similarly, for the ROE of Lockheed Martin, we first go to the income statement to find the net income. Then we go to the balance sheet to find the total share equity. And finally we divide the net income by the share equity to get the ROE. As seen, the ROE of Apple in the recent years has been in the range of 110% to 348%. With an average of 192%. If you still remember the ROE of Apple from the last slide, it is 85%. So Lockheed Martin earns more than twice for every dollar of equity on its book than the Apple. Does this make Lockheed Martin a much more profitable business than Apple? Share equity does not reflect the actual capital employed by Apple. For one thing, the business has a large amount of cash on its book. Whether holding a large amount of cash is good or bad is a different topic for another day. But as a business accumulates more and more cash, the book value increases and therefore ROE decreases. But this doesn't mean the business is becoming any less profitable at all. It could just still be the same profitable business that has more and more cash on hand. And in any case, the idle cash sitting on the book is not actually involved in the business operation. And in this case, the use of ROE is misleading because the inclusion of such idle cash distorts the picture of profitability. And for Lockheed Martin, its share equity does not reflect the actual capital employed either. The business has returned most of its equity back to the shareholders already. And the book value decreases and therefore ROE increases. But this doesn't mean the business is becoming any more profitable. It is just the same profitable business that has confidence in its future earning power and decide to return share equity. By the way, it is not that Apple is not confident in its future earnings. It is just whether a business decides to return its shared equity to shareholder or not, has no relevance to the fundamental profitability of the business. As a result of the distortions caused by the equity, comparing Apple to Lockheed by ROE or net profit margin is truly like, well, comparing apples to oranges. The net profit margin comparison and the return on equity comparison does not help us. Even worse, the comparison is not only not useful. The comparison can be even misleading if we are not careful. So what should we do now? The key to evaluate different stocks is to measure the return of capital actually employed in a business. The operative word here is actually. And the critical concept here is ROCE. ROCE is critically important because it measures the return of capital actually employed in a business. And it, therefore, provides fundamental insights into profitability. The importance is better illustrated by explaining the differences between ROCE and the more commonly quoted return on equity as we just analyzed. By definition, ROCE equals the profit earned by a business divided by the capital actually employed to earn it. So if a business has a ROCE of 20%, it means for every $1 of capital the business actually employs, the business earns 20 cents. Not that bad of a profitability. Similarly, by definition, ROE equals the profit earned by a business divided by the shareholder equity on the book, actually employed to earn it. So again similarly, if a business has a ROE of 20%, it means for every $1 of shareholder equity that sits on book, the business earns 20 cents. So ROCE would simply be the same as ROE if the book value equals the capital actually employed. But more often than not, the book value and the capital actually employed are two very different things, as we have seen in the examples of Apple and Lockheed Martin already. And as a result, ROE is quite useless or even misleading for profit evaluation. And we will use Apple and Lockheed as an example to illustrate the above next. So what are the capital actually employed for a business like Apple or Lockheed Martin? To estimate the ROCE of businesses like Apple, I consider the following items capital actually employed. A. Working capital, including payables, receivables, inventory. These are the capitals required for the daily operation of their businesses. B. Gross property, plant, and equipment. These are the capitals required to actually conduct business and manufacture their products. C. Research and development expenses. Such expenditures are an essential expense for a technology business like both Apple and Lockheed Martin. Based on the above considerations of capital actually employed by Apple, here is a tutorial to analyze it step by step. First, we look up the operation cash flow from the cash flow statement. Operation cash flow is a more accurate measure of earnings than the net income from the income statement. Second, we work out the working capital requirements. Again, these include payables, receivables, inventory. And all these items can be looked up from the balance sheet. Third, we look up the gross property, plant, and equipment. And all these items can also be found in the balance sheet. Fourth, we look up the research and development expenses. These are usually found in the income statements, or the footnote of the income statement. After we get all the above inputs, we can now sum them up to obtain the total capital actually employed by Apple to make money. And finally, by dividing the operation income with the total capital employed, we get the ROCE on the last row. As seen, Apple was able to maintain a remarkable high level of ROCE over the recent past decade. It has been in a range between 121% and 179% with an average of 144%. The next slide will put things under perspective by comparing it with the row we analyzed earlier. Now this chart shows Apple's true earning power based on the analysis we just did. Again, as seen graphically this time, Apple was able to maintain a remarkable high level of ROCE over the recent past decade. On average of 144%. If you still remember the row analysis we performed earlier, its average row has been about 85%. So now you can see how much the row analysis distorts the profitability picture. In this case, it substantially underestimates the profitability of Apple. And now, if we repeat the same ROCE analysis for Lockheed Martin, we will see that its ROCE is about 35%. So Apple is indeed a more profitable business than Lockheed Martin. For every dollar of capital actually employed, Apple earns more than 4 times the profit than Lockheed Martin. At this point, you may wonder, naturally, then who would buy Lockheed stock? Well, first, we bought and hold both Lockheed Martin and Apple stocks ourselves. Even though we fully understand and agree that Apple is a more profitable business than Lockheed Martin. Our reasons are as follows. As investors, we face many risks. 2 of the major risks are A. Quality risk or value trap, that is paying a bargain price for something of horrible quality. B. And valuation risk, that is paying too much for something of superb quality. In either case, you would not make money as an investor. The sweet spot for a value investor and a disciplined investor like Mr. Warren Buffett is somewhere in the middle. To look for an optimal trade-off between quality and valuation. And to refuse to pay a high premium no matter how good a stock is. And also refuse to buy a horrible business no matter how low its price is. With this background, we can see why we are comfortable holding both Lockheed Martin and Apple. Both are excellent businesses and definitely not value traps. And both are in the optimal trade-off between quality and valuation. As seen, the market is rational with both stocks too. Apple is more profitable, therefore you have to pay for a higher price to get it. It is currently valued at about 27 times of its earnings. And Lockheed Martin is less profitable, therefore you can get it at a relatively lower price. It is currently valued at about 13.4 times of its earnings. Almost a half of Apple's valuation. At this point, the next question is obviously how much price we would be willing to trade for how much profitability. That is an interesting and almost $1 million question. And we will discuss that in our future videos. Finally, let me emphasize that all the above comparisons are relative to each other. Both Apple and Lockheed Martin are excellent businesses. To see how good they are, let's examine them under a broader perspective and compare them against the broader economy. As seen, in terms of return on equity, Apple is lower than Lockheed Martin as we've established before. But both Apple and Lockheed Martin are substantially above the overall economy, whose return on equity is about 16%. Also as seen, in terms of net profit margin, Lockheed Martin is lower than Apple again as we've established before. But both Apple and Lockheed Martin are also above the overall economy, whose net profit margin is about 10%. So Lockheed Martin's net profit margin, even though lower than Apple's, but it is higher than the average of the overall economy. Therefore, it is higher than at least more than a half of the businesses in the overall economy. With that, hope you've enjoyed the video and we will wrap up here. To summarize and recap, The use of many metrics such as return on equity and net profit margin can distort profitability, making the analysis useless when comparing different stocks. ROCE measures the return of capital actually employed in a business. It stands for the return on capital employed. It is also known as ROIC, ROIC, return on invested capital. ROCE is the most important metric for profitability evaluation, because it reveals the true earning powers of different businesses. Thanks for watching and see you next time.